Welcome back to CMA USA Exam Coach. In our last episode, we discussed net present value in detail. In this episode, we are going to compare three important capital budgeting tools: net present value, internal rate of return, and accounting rate of return. These tools are used by companies to evaluate long-term investments and decide which projects are worth pursuing. Each method provides a different perspective. NPV tells us the value created today, IRR tells us the rate of return on the project, and ARR focuses on accounting profits. By comparing them side by side, we can better understand their strengths, limitations, and how they are applied in decision-making.
As we discussed in the last episode, net present value is calculated as the present value of inflows minus the present value of outflows. We even solved a few examples. Now let's think about a situation. Usually we know the number of years or periods for the expected cash inflows. But what if the inflows are unlimited? In other words, there's no fixed number of years. What does that mean? Well, if we cannot identify the years, then we cannot directly identify the discount factor, because present value factors are based on time. In such cases, we use the concept of a perpetual annuity. This simply means cash inflows continue forever. For example, if you are receiving dividends from an investment, and those dividends keep coming regularly without an end, that's a perpetual annuity. Another example could be land rentals. Imagine you own a piece of land and lease it out. As long as the land exists and the lease continues, you keep receiving regular rental income, potentially forever. So, in these cases, instead of using the normal present value tables, we apply the formula for perpetual annuity. When an equal amount of cash inflow is received for an infinite number of periods, we call it a perpetuity or perpetual annuity. The formula to calculate its present value is very simple. PV equals annual cash inflow divided by discount rate. So instead of multiplying with a present value factor for a specific year, we just divide the fixed annual inflow by the rate of return or discount rate. Let's take an example. Suppose the initial investment is $100,000 and the annual cash inflow is $20,000. The cost of capital is 10%. Step 1. Apply the formula. PV of perpetual annuity equals 20,000 divided by 0.1, which is equals to 200,000. Step 2. Now calculate NPV. NPV equals PV of inflows minus initial investment, and 200,000 minus 100,000, $100,000. So, the project creates a positive NPV of 100,000, which means it's financially worthwhile. This is how we calculate NPV when it is perpetual annuity. Now let's move a step further and talk about a perpetual growing annuity. A perpetual growing annuity is a situation where annual cash flows are received forever, just like a regular perpetuity, but with a twist. Each year, the cash inflow grows at a constant rate. For example, in our previous slide, we discussed leasing land. The rental income from the land will not remain the same forever. It may increase every year or every 2 years, depending on the lease agreement. This increasing rental income is a perfect example of a perpetual growing annuity because the cash flows continue indefinitely and grow over time. The formula to calculate the present value of a perpetual growing annuity is PV of perpetual growing annuity equals annual cash flow received at the end of first year divided by discount rate minus growth rate. Let's look at a simple example of a perpetual growing annuity. Suppose the initial investment is $100,000. The project is expected to generate $20,000 every year, and this cash flow will grow at 5% per year indefinitely. The cost of capital is 10%. Step 1. Calculate the present value of the perpetual growing annuity using the formula PV equals annual cash flow received at the end of first year divided by discount rate minus growth rate. PV equals 20,000 divided by 10% minus 5%, where 20,000 divided by 0.05 gives the answer $400,000. Step 2. Calculate NPV. NPV equals PV of inflows minus initial investment. NPV equals 400,000 minus 100,000 equals $300,000. This positive NPV of $300,000 shows that the project is financially very attractive, and it creates significant value for the investor. Now let's connect the concepts of risk, cost of capital, discount rate, and net present value. When companies evaluate a new investment, they don't just blindly apply the same discount rate. Instead, they adjust the discount rate depending on the level of risk in the project. If the new investment is riskier compared to the company's existing projects, then a higher discount rate is applied. A higher rate reduces the present value of future cash inflows, making it harder for the project to show a positive NPV. This acts as a safety cushion. On the other hand, if the new investment is less risky than the company's existing projects, then a lower discount rate is applied. A lower rate increases the present value of cash inflows and makes it easier for the project to be accepted. So, adjusting the discount rate is a way for management to reflect the project's risk in the NPV calculation, ensuring that decisions are realistic and aligned with the company's risk appetite. Let's take a closer look at how risk affects NPV using this example. Suppose a company is considering a project with an initial investment of $200,000. The expected cash flows are the same in all cases, but the company adjusts the discount rate based on the level of risk. When the risk is low, the discount rate is set at 8%, and the NPV comes out to $50,000. This is a healthy positive NPV, indicating the project is very attractive. When the risk is high, the company raises the discount rate to 18%. The NPV drops to $15,000. Although still positive, the return is much lower, reflecting the higher risk. When the risk is very high, the company further increases the discount rate to 23%. Here, the NPV becomes negative $10,000, meaning the project is expected to destroy value. Project is high risk, but project cannot give a positive return. In this case, the company would likely reject the project because it does not provide a positive return for the high-risk investment. So, this table clearly shows why adjusting the discount rate for risk is important. It helps management make realistic investment decisions and avoid projects that are too risky. Now that we understand how and why companies adjust their cost of capital to match the risk profile of a project, the next step is to understand the NPV profile. The NPV profile helps us visualize how a project's net present value changes as we vary the discount rate. It shows the relationship between the required rate of return and the expected profitability of the investment. By studying the NPV profile, we can see at what discount rate the project breaks even, how sensitive it is to changes in risk, and ultimately make more informed investment decisions. As you know, discounting means we are adjusting our future inflows to reflect the time value of money. If the discount rate is higher, the inflow reduces. For example, if we have an inflow of $100,000 in year 1, discounting it at 10% gives us about $90,909. But if the discount rate increases to 15%, the inflow reduces further to approximately $86,957. This simple example shows that as the discount rate increases, the value of future cash inflows decreases. All right, class, let's take a closer look at this table and understand how the NPV of a project is affected by the discount rate. Notice here, when the discount rate is low, at 5%, the NPV is high, around $300,000. This tells us that when the cost of capital is low, the project is expected to generate significant value for the company. Now, as we increase the discount rate to 10%, the NPV falls to $150,000. You can see that even a moderate increase in the rate has a noticeable impact on the project's value. This happens because higher discount rates reduce the present value of future cash inflows. If we continue to increase the rate at 20%, the NPV becomes zero. This shows that at higher discount rates, the project's value is completely offset by the cost of capital. Finally, if the discount rate is increased further to 25%, the NPV turns negative, around minus $75,000. This clearly shows that the higher the required return or risk, the less attractive the project becomes. So, the key takeaway for you as future managers is that the discount rate is not just a number. It directly reflects the risk and required return, and it has a major impact on whether a project is acceptable or should be rejected. Always remember, higher rates reduce NPV, lower rates increase NPV, and this is exactly why we carefully match the cost of capital to the project's risk profile. Now that we have our NPVs for different discount rates, let's put these values into a graph so we can see the pattern visually. On the y-axis, we'll put the NPV values, and on the x-axis, we'll put the discount rates. When we draw the points and connect them, we get a downward sloping curve. Let me explain why it slopes downward in a simple way. Remember, the discount rate is like the cost of money, or the required return for the project. When this rate is low, future cash inflows are worth more in today's terms, so the NPV is high. But as the discount rate goes up, those same future inflows are worth less today. Since NPV is calculated by taking the present value of all future cash inflows minus the initial investment, a smaller present value of inflows means a smaller NPV. That's why the curve goes down as we move to the right, showing higher discount rates. This graph is very helpful because it gives us a visual picture of how sensitive a project is to changes in the discount rate. It makes it clear that as the required return or risk increases, the attractiveness of the project decreases. By looking at this slope, we can quickly understand how changes in risk or cost of capital affect our investment decision. Now let's focus on a very important point on our NPV graph, the point where the NPV is 0. In our example, this happens at a 20% discount rate. At this rate, the project neither makes a profit nor a loss. The inflows exactly cover the initial investment. This specific rate, where the NPV equals 0, is called the internal rate of return, or IRR. IRR is a key tool in capital budgeting because it tells us the maximum discount rate a project can bear before it stops being profitable. In other words, it helps managers quickly assess whether a project meets the company's required return and risk expectations. So, in simple terms, IRR means the rate at which the NPV of a project is 0. In the next section, we will dive deeper into how to calculate IRR and use it alongside NPV to make smarter investment decisions. Before we dive deeper into IRR, let's understand an important concept called the crossover rate. First, remember that whenever a company changes the discount rate, the NPV of a project also changes. Each company may have its own required return or cost of capital, which affects the NPV differently. Companies often adjust the discount rate to match their risk and return expectations, and this is reflected in the NPV profile. Let's look at our example with two projects from two different companies. For the first project, the NPV at the initial discount rate is $300,000, and for the second project, it is $200,000. If we examine the IRR for each, the first project reaches an NPV of 0 at a 20% discount rate, and the second project reaches 0 at 30%. Now, if we plot the NPV profiles of both projects on the same graph, we notice something interesting. The two downward sloping curves intersect at a certain point. This intersection is called the crossover rate. In our example, the crossover rate is approximately 12.5%. So what does this mean? At a discount rate of 12.5%, both projects will have the same NPV, even though their initial NPVs and IRRs are different. In other words, if a company decides to use a 12.5% discount rate as its cost of capital, both projects become equally attractive in terms of net value. The crossover rate helps managers understand the discount rate at which two different projects are equally preferable, and it is very useful when comparing mutually exclusive projects or making investment choices between alternative projects. For your exam, you may be asked a scenario like this. There are two projects, and their NPV profiles intersect at a discount rate of 12.5%. If the company's cost of capital is also 12.5%, which project should the company select? The answer is actually simple. The company can select either project. Why? Because at this discount rate, both projects give the same NPV. In other words, in terms of creating value for the company, both projects are equally attractive. This is exactly why the crossover rate is important. It shows the discount rate at which two projects are equally preferable. So, if the company's cost of capital happens to match the crossover rate, there's no financial advantage in choosing one project over the other. Both will contribute the same net value to the company. Let's look at an example to understand the crossover rate, which is very useful when a company must choose between two projects. Suppose a company is considering two projects, A and B. Each project requires the purchase of a new machine, but the company can accept only one project because there is space for only one new machine in the factory. Here are the details. Project A requires an investment of $50,000, provides annual cash inflows of $15,000, and has a project term of 5 years. Project B requires a larger investment of $150,000, provides higher annual cash inflows of $44,000, and also has a project term of 5 years. Now the question is, at which discount rate would the company be indifferent between these two projects? In other words, what is the discount rate at which both projects give the same NPV? This discount rate is called the crossover rate. At the crossover rate, the company would be indifferent, meaning either project could be chosen because both will contribute the same net value to the company. To find the crossover rate, we first calculate the differences in cash flows between the two projects. Then, we find the discount rate that makes the NPV of the differences equal 0. At that point, the NPVs of Project A and Project B are exactly the same, and the company cannot favor one over the other based on NPV alone. In simple terms, the crossover rate tells us the point where the two projects are equally attractive, helping managers make a better decision when comparing mutually exclusive projects. We know that the crossover rate is the discount rate at which the NPV of both projects is equal. Mathematically, we can write this as NPV of Project A equals NPV of Project B. In other words, PV of inflows for A minus PV of outflow for A equals PV of inflows for B minus PV of outflow for B. Substitute the values 15,000 multiplied by annuity factor minus 50,000 equals 44,000 multiplied by annuity factor minus 150,000. Now, we solve for the annuity factor. First, move the numbers around. 150,000 minus 50,000 equals 44,000y minus 15,000y, where y is the annuity factor. Simplifying, 100,000 equals 29,000y. Y equals 100,000 divided by 29,000, which is approximately 3.44. Finally, using the annuity table, we find that an annuity factor of 3.44 for 5 years corresponds to a discount rate of approximately 14%. This means the crossover rate is 14%. At this rate, the NPVs of Project A and Project B are exactly the same. So, if the company's cost of capital is 14%, it would be indifferent between choosing Project A or Project B, because both projects would add the same value to the company. Understanding the crossover rate helps managers decide which project is better under different discount rates and compare mutually exclusive projects effectively. Next, let's discuss some of the key features or characteristics of IRR. 1. Definition-based. IRR is the discount rate at which the net present value, NPV, of a project equals 0. In simple terms, it's the break-even rate of return, the point where the project neither makes a profit nor a loss. For example, if a project has an IRR of 15%, it means the project is expected to earn 15% per year on the invested money. 2. Time value of money. IRR considers that a dollar today is worth more than a dollar in the future. It discounts future cash inflows back to today's value. So, a project that returns 100,000 5 years from now is worth less today than one returning 100,000 next year. Third decision rule. The IRR helps in decision making. If the internal rate of return is higher than the company's required return, the project is considered profitable and worth accepting. If it is lower, the project should be rejected. For example, if your company wants at least a 12% return and a project's IRR is 15%, it's a good choice. 4. Expressed as a percentage. Unlike NPV, which is in dollar terms, IRR is expressed as a percentage. This makes it easier to compare with the company's cost of capital or other investment opportunities, just like comparing interest rates on savings accounts. 5. Independent of project size. IRR focuses on the rate of return, not the total profit. A small project with high IRR can look more attractive than a large project with slightly lower IRR, even if the large project creates more total value. 6. Difficult to calculate with irregular cash flows. When a project has cash flows that are not uniform, like an initial inflow, then an outflow later, and another inflow afterward, the IRR calculation can become tricky and may even give multiple answers. That's why financial software is often used for complex projects. 7. Ranking limitation. IRR may not always correctly rank mutually exclusive projects. For instance, if Project A has a smaller investment but higher IRR, and Project B has a larger investment but slightly lower IRR, choosing solely based on IRR may not maximize total company value. 8. Sensitive to timing of cash flows. IRR increases if the project delivers cash earlier, because money received sooner is worth more. Conversely, if most of the cash comes later, IRR will be lower, even if the total inflows are the same. 9. Crossover concept. When comparing two projects, IRR alone can be misleading. Sometimes one project may be better at lower discount rates and the other at higher rates. The point where their NPVs are equal is called the crossover rate, which helps managers decide which project is more attractive under different conditions. 10. Widely used. Tool. Despite some limitations, IRR is popular because it gives a single percentage return that's easy to understand. Managers, investors, and even students like it because it directly communicates how profitable a project is relative to the required return. 11. Multiple IRRs possible. Sometimes a project doesn't have simple regular cash flows. Instead of having one initial investment followed by only positive inflows, it may have alternating inflows and outflows. For example, an initial investment of 100,000, then a positive cash inflow of 50,000, and later an unexpected outflow of 20,000. When a project has this kind of non-conventional cash flow, calculating the IRR can give more than one rate where the NPV equals 0. This is because the NPV formula may cross the zero line multiple times, depending on the timing and sign of cash flows. In simpler terms, imagine a project's NPV curve going up and down instead of smoothly declining. It could intersect the zero line at 2 or more points, meaning there are multiple IRRs. For managers, this can be confusing because IRR alone may not tell the full story in such cases. That's why, for projects with unconventional cash flows, it's better to look at NPV directly and use IRR carefully, rather than relying on it as the only decision-making tool. Let's solve an example to find the internal rate of return, or IRR, using the annuity table. We have a project with an initial investment of $150,000, a project life of 5 years, and annual after-tax cash inflows of $39,000. The company's cost of capital is 8%, but our goal is to find the IRR. the rate at which the project's NPV becomes zero. Step 1. Recall the definition. IRR is the discount rate at which NPV equals zero. Step 2. Write the NPV formula. NPV equals PV of inflows minus PV of outflow. Since NPV equals zero for IRR, we have 39,000 multiplied by annuity factor minus 150,000 equals zero. Now, here we see that 39,000 inflow multiplied by the annuity factor equals the outflow of 150,000. In simple words, it seems like 150,000 equals 39,000. How is this possible? This is because we are discounting the 150,000 over 5 years, and the present value of the future inflows, when multiplied by the discount factor, equals the initial outflow. So the question is, what discount factor will make 39,000 inflows equal 150,000 outflow? Let's find that. Step 3. Solve for the annuity factor. Annuity factor equals 150,000 divided by 39,000, which is approximately 3.846. Step 4. Using the annuity table, look for the 5-year annuity factor closest to 3.846. From the table, this corresponds to a discount rate of approximately 9%. So, the IRR of the project is 9%, which means if the company uses a discount rate of 9%, the project's NPV will be zero. This example shows how we can use the annuity table to simplify IRR calculation, especially when cash inflows are equal each year. It helps us quickly understand the effective rate of return of a project without calculating the exact present value of each inflow individually. Now let's discuss another important concept, the relationship between NPV and IRR, and what it tells us about the riskiness of an investment. First, remember that IRR is the discount rate at which NPV equals zero. But in real life, projects are evaluated at the company's cost of capital, not exactly at the IRR. So the difference or gap between NPV and IRR becomes very important in assessing risk. When the difference between IRR and the company's discount rate is large, and NPV is still positive, the project is considered safe. This is because even if there are small fluctuations in cash flows or market conditions, the project still generates positive value. For example, if the company's cost of capital is 15% and the project's IRR is 20%, there is a comfortable gap of 5%. In this case, the investment has a safety margin, and the project is less likely to turn unprofitable. On the other hand, when the difference between IRR and the cost of capital is small, and NPV is still positive, the project becomes risky. Even a small negative change in forecasted cash inflows or a slight increase in costs can turn the NPV negative, causing the project to start losing money. For example, if the cost of capital is 19% and IRR is 20%, the margin is only 1%. Any small variation in the market, like higher costs, lower sales, or delayed cash inflows, can make the project unprofitable. So the key takeaway is, the larger the gap between IRR and the cost of capital, the safer the investment. The closer they are, the riskier it becomes. Always pay attention to this relationship when evaluating projects because it gives a practical measure of how much cushion your investment has against uncertainties. Let's take a practical example to understand this better. Suppose a project has an IRR of 20%. Remember, IRR is the discount rate at which the NPV equals zero, meaning the project is neither making a profit nor a loss at that rate. Now, if the company uses a lower discount rate, say 12%, the present value of future cash inflows will increase. In this case, the NPV might rise to around 100,000. This shows a large gap between the NPV at the cost of capital and the IRR, which indicates a safe project. Even if there are small fluctuations in cash flows, the project still generates substantial value. On the other hand, if the discount rate is closer to the IRR, say 19%, the NPV might only be 2,000. Here, the gap between NPV and IRR is very small, meaning the project is risky. Even a tiny drop in cash inflows or an increase in costs can turn the project's NPV negative, making it start losing money. So, the key point is that the gap between NPV and IRR determines the safety of a project. The larger the gap, the safer the project. The smaller the gap, the higher the risk. This is an important concept to remember when evaluating investment decisions. Now let's discuss another method used in capital budgeting called the accounting rate of return, or ARR. Unlike NPV or IRR, which are based on actual cash inflows and outflows, ARR is calculated using accounting income. That means it relies on revenues and expenses recorded in the accounts, including both cash received and receivables, as well as cash paid and payables. In other words, it follows the accrual concept of accounting. So, there is a clear difference here. Net cash flow is calculated from actual cash inflows and outflows, while accounting income is calculated from revenues and expenses, whether or not cash has actually been received or paid. The formula for ARR is very simple. ARR equals annual after-tax net income divided by the initial investment, multiplied by 100. Let's take an example. Suppose a project generates an annual after-tax net profit of 100,000, and the initial investment required is 1 million. So ARR equals 100,000 divided by 1 million multiplied by 100, which gives us 10%. This means that based on accounting profits, the project is expected to generate a 10% return on the investment. ARR is easy to calculate and useful for quick comparisons between projects. But keep in mind, unlike NPV or IRR, it does not consider the time value of money. That's why ARR is considered a simpler, less precise tool for evaluating long-term investments. As we discussed in the example of 100,000 profit, it is very important to note that this is not actual cash. Accounting profit is not the same as cash flow. Why? Because accounting profit includes things like accruals, provisions, and adjustments that are recorded in the books, even if the money has not actually moved. For example, revenue might be recognized as receivable, or expenses might be recorded as payable, even though no cash has yet been exchanged. On the other hand, when we calculate NPV, we always use actual cash inflows and outflows. That's why NPV gives a more accurate measure of the project's real value, while ARR only reflects profitability on paper, based on accounting rules. So the key difference is ARR looks at accounting profit, while NPV looks at real cash, and in capital budgeting, cash is always more reliable than accounting profit. Let's summarize NPV, IRR, and ARR as shown in the table. NPV, or net present value, tells us the present value of inflows minus the outflows. It is calculated using actual cash flows and considers the time value of money. The decision rule is simple. Accept the project if NPV is positive, reject if it is negative. The result is expressed in currency value, like $50,000, which makes it very clear how much value a project adds. It is also considered the most reliable method. IRR, or internal rate of return, is the discount rate at which NPV becomes zero. Like NPV, it is based on cash inflows and outflows and considers the time value of money. The rule is, except if IRR is greater than the company's cost of capital. The result is expressed as a percentage, for example, 12%. It's widely used but sometimes tricky because in projects with unusual cash flows, multiple IRRs are possible. ARR, or accounting rate of return, is different. It uses accounting profit, not cash, and does not consider the time value of money. The rule here is, except if ARR is greater than the target rate of return. Like IRR, it is expressed as a percentage, for example, 10%. ARR is very easy to calculate but less reliable because it is based on accounting numbers, not actual cash. So in short, NPV is the most reliable and precise. IRR is widely used and gives a percentage return, and ARR is the simplest but least accurate for long-term decisions.
Thank you for watching this episode. If you ever feel confused about NPV or IRR, don't worry. Students often have doubts in this topic. I encourage you to watch this lesson again for clarity, and most importantly, practice the questions from your question bank. Also, make sure to read your textbook to gain deeper understanding and clear up any remaining doubts. Keep practicing, keep revising, and you'll master this topic with confidence. See you in the next episode.